the question is, how do you interpret the recent U.S. inflation data? And do you see it as an outlier, or is this a new trend?
Well, we've certainly gone from a period where inflation was at, depending on what measure you're looking at, something in the 5, 6, 7% range to something that's closer to the 2 to 3% range. That's basically where we're at right now. And even though we spend a lot of time like squinting, is it like 2.8 or 2.7 or 2.9 or whatever, like, who cares? Like, it's at some level, it's still a bit elevated. It's a little high for the Fed's preference. Basically it will remain unless there's some sort of unexpected shock. It will likely continue to be elevated relative to the Fed's preference. And that elevation is the thing that is an important consideration when it comes to the Fed not proactively cutting. I think we came into 2024, a lot of people were essentially trading off of or keying off of Waller's comments that they were going to do an easing in order to contain in order to bring what was perceived as real rates down. And that was essentially, in some ways, you could look at that like a proactive easing, right? Even though, the economy didn't deteriorate, they were going to proactively ease. I think the fact that inflation is stabilized here at a level that is a bit above where their target is, and the Fed's response, even the dot plot, gave some indication, shifting to only one cut rather than two cuts, rather than three cuts in the most recent dot plot, all points in the direction of like, look, inflation is a little too high. We're not going to proactively ease. And so, expect this monetary policy position that we're going to be in, expect it for a long period of time. And honestly, like, you'd be a lot better off just like stop listening to certainly stop listening to the Fed and certainly stop listening to those governors. Like, they have no idea what's going on, and they certainly have no idea what future monetary policy is going to be. And so, like, you're much better off just not listening to them and just kind of pencil in the Fed. It's like, it's going to be hot. Rates will be elevated. They're not going to proactively ease unless growth slows, and just like and move on. There's other things that are more interesting to be thinking about these days.
I love that you're saying this, Bob, because I think that for so many traders out there and investors, they're trying to read the tea leaves of what the Fed is going to do. And from watching your posts on X, listening to your other interviews, hearing you today, it is not the primary reason the market is moving and doing what it is right now. And I think it's so important because traders get so caught up into what is that macro theme, what is driving this. And you see so many people talking about, well, the Fed's getting ready to cut rates, or, the Fed was raising rates, we couldn't go higher. And all these things, I think, really get into their subconscious. And it's caused a lot of traders to struggle, I think, because it's the environment that we've been in for so long. And to remove ourselves from that, just like it was, I remember when we got into where all we watched was the Fed, I couldn't wait to be out of it. It's like that breaking up with your girlfriend or that divorce from that. You're like, I still feel like there's this connection there, but do I just remove myself from it? And so I want to go to really how you view the current stance of the Federal Reserve. What impact do you think their policies have had on inflation, growth, and on bond yields? Where do you see them in the coming months?
The Fed's actions and just more generally, like monetary policy and the repricing of interest rates in the economy. Basically, we went from a period of very, very low interest rates for a long period of time to a period of recognition that, hey, interest rates are not going to be, nearly as low as they were in the post-GFC period. For a variety of different reasons. Both the economy has healed and is stronger than it was then, as well as the fact that, we're seeing inflationary pressures. And so that created a reset of interest rates. But if you really look at it, like, what have two-year bond yields done over the course of the last, 2 years? They've basically been in the same range, right? Reset to a higher level. The 10-year bond has basically been in the same range. There's a lot of conversation. Is it 430 or 475 or whatever? But like, we were at, under 2, and now we're at 4 to 5, right? And we've basically been in that range. And if anything, like, it's been sort of range bound. Like, you've been better off fading extreme expectations, either bond yields particularly high or bond yields particularly low, or the Fed tightening a lot or not easing at all, or versus the Fed, easing a lot. Like, you've been much better off the last 2-ish years fading those wiggles, because there's not a lot of information value in the wiggles. If anything, it's just people's expectations that are like flipping around, that are much more volatile than the economic reality. And the economic reality is we're in a higher interest rate environment. The economy was very strong 2 years ago, coming out of COVID and with very high income growth to households, tighter monetary policy, and plus the natural sort of meeting the economic, the limits, the economic capacity in the economy has meant now that growth is slowing down modestly. And we're sort of seeing the sort of slow decay of the economy. Income growth was at 6 to 7, and then 5 to 6, and then 4 to 5. And employment growth was at 500,000 jobs, and then 300,000 jobs, and then 150,000 jobs. And that sort of decay over the course of years is actually very normal for, I'd call it sort of a traditional business cycle. Like that's how business cycles work, which is, the economy's too hot, interest rates rise, the economy slows down, it takes a while. It's kind of death by 1,000 cuts, rather than some acute moment where it's like, oh, today we walk in and we're in recession. It's not how typical economies work unless there is an external shock like COVID or an unusual credit crisis dynamic like we saw in 2008. But neither of those things are, well, who knows if we'll have another COVID? I can't predict that. But certainly we're not in a position to have an acute credit crisis shock right now. So we're just kind of getting slow but sure decay from elevated interest rates.